Hey guys, before we get started with the market update, let me direct your attention real quick to our end of year super sale. We're going to offer RepliQuants Unlimited, which is our options offering. It usually goes for $149 per month, and we're going to offer it all through December as a special deal for only $597 if you sign up for 6 months, or $997 if you sign up for an entire year. That's a massive discount, and if you're interested, simply go to repliquants.com/super sale. That's repliquants.com/super sale. Welcome back to this mic of RepliQuants. It's Monday, December 5th, 2022. Just a few hours to go until the opening bell. Let's get you guys ready for the week. Now, looking at this chart, the SPX, the daily, tells the story. What has occurred over the course of this year. The contrast couldn't be any starker if you compare it with 2021. 2021, we're looking at this beautiful bull market advance. This correction at the time was considered to be quite significant, and these are the types of moves we're getting now almost on a weekly basis. And then we advanced all the way into the end of the year, and then it fell off the plate almost immediately, and it's been nothing but big swings ever since. And this has been hell, even for directional traders, because after the fact, it's very easy to draw these types of channels and say, oh, this looks pretty solid, right? Let's turn around here. Well, are we actually going to turn right here or not? That's the question. Because at this point, this market is so data dependent, and mentality is almost manic depressive in that it swings from one extreme to the other. It's very difficult to trade in this environment. And when you're looking at the VIX, right here, we're now dropping down into 19 or potentially below today. We haven't spent almost any time down here over the last year. Year to date, I think we probably spent only 3 or 4, maybe 5 days below 19. And if we're actually dropping low here, maybe to 18, maybe to 17, I'd love to see it at 16. I would be backing up the truck. Because, why? Well, this is a great environment to load up on some of my CYA spreads. You know what that stands for? And obviously it's used for downside protection, for hedging, and can produce massive profits once the market turns to the downside. The difference to a naked put, for example, is that it can be held for long term, and you don't have to worry too much about theta burn. Or even implied volatility changes. It really kicks in massively after a particular threshold, depending the way you construct it. And that's something we're probably going to be talking about. I might even do a webinar in the very near future. So it's something to look forward to the weeks to come, especially if we're seeing the VIX down there. That would be really great. But if you're looking at the VVIX as well, which is the volatility of implied volatility, again, it's coiling up. It's scraping the barrel down here still. And in my mind, I think the market is really reaching here. This is coiling up massively. And I think the Bigfoot will drop, and it will probably drop in the beginning of 2023. In a few weeks from now, because this is not sustainable. This is a market that is so highly data dependent. It only takes one match to set it off. Again, coming back here, let me show you something else. If you're looking at, for instance, the futures, we're looking at the hourly price action. And consider for a moment that 90% of the price action to the upside or downside happens in maybe 5% of the time. Normally it's around 11% of the time. And again, I'm spitballing here because I haven't done the stats, but I'm just visually looking at it. I'd say it's probably less than 5%. And again, what does that tell us about the market? This market is highly volatile. And once it jumps away from you. It's very hard to actually anticipate in which direction. CPI numbers lower, CPI numbers going to be higher. Are the numbers going to be cooked? Are they going to be revised? Anything can happen. Again, we're completely in a data-dependent market now. And in my mind, that's a very fragile market. So I don't think that taking directional bets here is the way to go, and that's what we've been trading conservatively. We've been taking defined risk trades over the past year, and it's worked very well for us. Now, of course, it's one thing to sell far the money options or sell one right here at the money, and that's something I always strongly discourage from doing. A few people have written in and asked me about that because we are trading strangles, but let's not forget that a strangle can be very easily converted into an iron condor, and I'm actually going to host a webinar on that in the near-term future. Again, this is a very data-dependent market, and that is a very fragile market. Anything can happen at any time. Directional trading is dead, at least for now. And the way we trade is always actually more or less direction agnostic. It doesn't care which way the market swings. We care more about ranges, and we care more about price distribution than we care about which particular direction the market will swing in a particular time frame. Now, if I take out a hedge, let's say on the spiders, let's jump out here, let's say 2 years. And let's say I want to protect myself from a drop to below 360. Again, my CYA spread, it works wonders in these scenarios, but that's more of a seasonal trade. It's not the bread and butter trades that we usually take at RepliQuants. So you have to differentiate. In normal circumstances, I want to be hedged against big moves to, well, either the up or downside, depending on market conditions, but the bread and butter trades are usually non-directional. And I think that's a big aspect of how we trade options at RepliQuants. Okay, that pretty much wraps it up for today. I'll see you all next time.